Okay.
We're talking about the 4 types of income not taxed in retirement. So what are those 4 types of income that are not taxed? And when we're talking about not taxed in retirement, we're really talking about essentially the focus in retirement. And a lot of people don't get this. You know this, I know this. A lot of people don't know this. But what we really try to do is tax strategy is the battle moving into retirement. So you want to be in a position to pay less taxes when you retire on your money because it gives you more income. So the conversation we're having is you don't want to be taxed to death in retirement, ultimately. So can you explain to them the 4 main types of income that everybody associates with when they're thinking about income that's not taxed in retirement?
Yeah, when you talk about taxes, obviously it's the biggest play on our money in terms of loss going forward. That's the distribution phase when you go to retire. So those 4 items would be an HSA, which is a health savings account, a reverse mortgage, a qualified Roth distribution, and then lastly is a high cash value life insurance policy like an index universal life or a whole life insurance policy. So to kind of expand a little bit on how those function, that HSA, it's a little bit of a tricky topic there because you're getting that tax deduction on the year of the contribution. So each year that you're contributing, you're getting that tax deduction in terms of bringing down that tax liability for the year. Then that's growing tax-free within that particular plan. And then if you go to take the money out for a medical expense, that's a tax-free entity as well. But this is where it kind of falls short when it comes to if you're trying to pull out true income in retirement out of an HSA account and it's not for medical reasons, then that's going to act just like an IRA. So it's going to be taxed as ordinary income. So that's kind of where there's a kind of a fine line there of how that really becomes tax-free versus a taxable entity. That's just a fine line of how that particular plan works. Now, when you go into a reverse mortgage, this is some that I think a lot of people kind of hedge against and are not really sure about because I don't think they know enough about the plan to see how this can truly be a potential benefit for them in retirement. This is age restricted. So you have to be, there's a minimum age that you can exercise a reverse mortgage. It is a tax-free benefit that you can receive a monthly income to yourself to try to supplement and offset expenses in retirement. What you're doing is you're exercising equity out of your property. So the younger you are, the less equity you can take. The older you are, the more equity you can take, meaning you can get more money out depending on how old you are, the older you are. So what you can still live in the home. You're not having to leave the property. Everything is kind of squared up at the end when potentially the sale of the property occurs. So whenever that sale happens, you're then turning over that equity position or the sale of the property proceed wise of money you've taken out to the lender. So this is something that can work for people. It's not for everyone, but it's definitely an option down the road. Hopefully there's things that you're doing before that might be preceding a reverse mortgage. Qualified retirement distributions, you're getting that potential tax deduction based on your contribution for the year. It's growing tax-free. Your contributions are with after-tax dollars, and any distributions you take in retirement are also tax-free. So that is a true tax-free asset. The difference on some of those are, we don't get too involved in this, but you're still involved in the marketplace, the ups and downs, but you're also still subjected to that 59.5 rule in terms of when you have ability to access funds out of that plan. So it's not a liquid plan between now and the age of 59.5. Once you reach 59.5, then you have the ability to start exercising some of those tax-free funds. And then last but not least, that high cash value policy, whether it's an index universal life or a whole life policy, those policies have some slight differences, but again, it works like a Roth, very similar. You're putting in contributions, i.e. the premium into a plan after tax dollars. The policy cash value wise, compound interest grows tax-free, and then it's liquid and is able to be used during your lifetime. That 59.5 restriction is not there. And then you can use that cash whenever you want, wherever you deem necessary. And then potentially in the future, supplement income with this as well that continues to be tax-free. So that is a true tax-free plan that can be utilized. And it's a great strategy and a great foundation to kind of get things jump-started with your asset portfolio.
So let's rank these from top to bottom, because we just had a conversation about the HSA possibly not being a tax-free income vehicle, just simply because, like you said, it has like a triple tax strategy that people think of, where it's tax deductible immediately, your money grows tax-free, and you can use it for only medical expenses. But then if you do not use it for medical expenses, when you hit a certain age, it acts like a traditional IRA, and you would be taxed on everything that's within that plan. So it's really not the best tax-free income vehicle. I don't know if you would call it tax transfer. Like, you can actually transfer that money and use it for medical expenses. But the reverse mortgage is considered a loan. So that's why it becomes tax-free. Similar to the life insurance piece, they're just holding your equity as collateral and loaning you the money. So therefore, because it's a loan, it's not income, which gives you the ability to not owe taxes on the money that they're giving you, because they're loaning you those funds as they're loaning you the money instead of giving you the money. Therefore, it's not any kind of payment you're receiving. That's why you don't owe taxes on that money. Correct?
Yeah, it's definitely in essence a loan, because it's going against the property. So when it sells, you're not getting all of that money back like you traditionally would if you remained or retained that equity position. So yeah, that's correct. So yeah, the HSA, when they say income, I mean, I would classify that as the fourth out of these particular four that we're describing here, because if you are needing that supplement for medical expenses, you don't have to pull from other income to make those payments. So in theory, it is an income that's coming to you from a medical perspective. So it is tax-free. But as you stated, if this has to be flipped as truly turning this on as an income versus just medical expenses, that becomes a taxable event. So I would classify that kind of rank that as the fourth. I would go reverse mortgage as 3. I'd go that qualified Roth distribution as 2. And then I would go as that the high cash value policy, IUL or whole life, as 1. And the reason I don't flip the Roth to 1 and the life insurance 2 is because of the 59.5 rule of not having access to that money until that age. And then in addition to that, there's still the positive versus negative of the market of how you have that money allocated in the Roth. It can still lose, whereas the policies cannot in terms of the life insurance policies. So that's why I would make that 1 versus 2 in the Roth versus the IUL.
Yeah, I would give it the same ranking. HSA 4, reverse mortgage 3, qualified Roth 2. You know, not only what you mentioned about the Roth, but also you've got a limit on what you can contribute into the Roth as well. So being capped out, it's a great vehicle for someone who's, I guess, would be making less money, because their full retirement investment that they're putting back, that savings, it can actually fit within the Roth. But if you're a high income earning individual and you're trying to look for a place to put money that can grow tax-free and you can utilize later in life tax-free, then you're going to be limited on what you can actually put into the Roth plans versus a cash value life insurance plan. So let's go in depth a little bit more on the number 1 and best non-tax income vehicle out there, which would be the tax-free retirement, what we call tax-free retirement, with the IUL or cash value life insurance. I mean, there's really nothing out there that functions the way that cash value life insurance can function and can create a tax-free retirement for you down the line. These policies can be very big or they can be very basic. And the growth within the policy, one of the key things that Ron, I can't remember if you mentioned or not, one of the key features, and I want you to kind of explain this to them in a way that they can understand, but you can actually access the money over the course of the life of the policy. So when we talk about life insurance, a lot of people think about death insurance, which is when you pass away, this money is left behind. The life insurance within a high cash value policy or an IUL, it is designed for you to use while you're living, while you're still alive. So speak to them a little bit more in detail about how you have liquid access to your funds versus a Roth that's locked up until you're 59 and a half, or a HSA. Even if you're going to draw income off of it, it's still locked up until you hit retirement age. And even the limitations of a reverse mortgage, it's the same dynamic. The younger you are, the less equity they're going to give you, meaning the less of a payment you're going to receive. The older you are, the more of a payment you're going to receive, but you're still limited to only receiving a piece of your equity at a time. Whereas with the cash value and IULs and life insurance policies, you've got access to the full balance of your account. I think there's limits, maybe 80 to 90% that you want to withdraw at one time, but you still have liquid access to where you can utilize those funds while you're living. Explain that to them.
Yeah, it's truly becoming your own bank, honestly, is how that has to be viewed. Because you can exercise this, there's not limitations based on age, which most plans, if people are familiar with most of what they're involved with from a retirement perspective, most of their plans have an age restriction. That 59 and a half rule is pretty important when it comes to qualified money, like IRAs. Roth IRAs do the same thing. 401ks, 403bs, those types of plans are age restricted. So with a high cash value policy, it's not age restricted. It can literally be used throughout your lifetime. It's a living benefit, in essence, is kind of how you kind of look at this. You're prepaying a death benefit, more for simplistic terms. So if you have cash value that's built up, what's happening is it's a compounding interest. So anything that gains come in, it's stacking one on top of the other, $1 on top of another. So if you're building cash value, whatever returns are happening, that becomes your new floor. So what I mean by that is it can never go below that ever again in terms of the value of the cash, because it's protected against losses. In an IUL, the Index Universal Life, it's protected from losses. So you're protected, you're participating in the market, versus a whole life plan where you're getting dividends returns. It's not participating in the market, you're getting dividend returns. But again, there's a floor. It can never go below where you were the year before. So any gains that are happening are being attributed to what the new balance of your cash is. So if it's $100,000 of cash one year and you gain the next year, you gain, let's say $10,000, it's $110,000 the next year. The growth is off the 110, not the 100. So it continues to compound year after year after year. The dividend works in a similar fashion on a whole life policy where it's 100, you get a 6% or 7% dividend, let's say, that's $6,000 or $7,000 off of 100. That next year it's 106, 107, depending on that percentage of dividend. Then that next year, if it's 6 or 7% again, it's off 106 of that value to go up. So you're getting that compounding interest that's going up year after year, but your plan is completely protected from any losses that occur in any fashion within the markets. Being able to access the funds, you can utilize it to buy vehicles, college education for children, supplement income in the future. You can buy cars in this fashion. You can buy real estate in this way. You can do things with your own primary residence. It's truly your own banking system to make $1 act like 2, 3, 4, 5, depending on what you're trying to accomplish within your life. And the value of this is you're taking a loan like you described, but it's not a loan from you. This is kind of the fallacy of what people don't understand, I don't believe, with the policies. You're taking a loan from the insurance company. They're giving you the money against the collateralization of your policy, meaning if you pass, the beneficiary doesn't get all of that death benefit if there's money that's been loaned or borrowed against. So that gets reduced off the death benefit because you've in essence have prepaid your death benefit. But the beauty of it is if you have $100,000 of cash and you take $50,000 out, to maybe invest in a real estate property that's giving you passive income month after month after month. And we can teach you how to do these types of things where you can pay yourself back over time. This is the beauty of this. And at the same time, you're not losing the earning potential, the earning power of the dollars that's sitting inside your cash value. So in other words, that 100,000 is no longer available to borrow against all 100 because you've taken 50, but the growth is. So the growth is still being attributed to the $100,000 because you've taken it from the carrier, not your policy. You just have the 50,000 that you've taken and you've used. So you don't have full $100,000 availability of cash. You have 50 to use still, but the growth goes off the 100. This is where this is the major difference versus any other product out there. You still are growing as if you've never touched the money. You do that in any other asset plan, you lose that money and earning potential on that money going forward because it's not there. You take 50 out of an IRA or 50 out of a Roth or 50 out of a mutual fund, that's gone. You don't get the growth on that anymore. This plan does that. That's the major difference in terms of the growth, but the taxation is huge because you don't have to explain why you're taking the money out and you don't pay any income taxes. So this doesn't hit a credit report, nothing along those lines. So when we say act like a true banking system, that's what it really does. So when you look at the comparisons and things that we just talked about, the reverse mortgage, the qualified Roth distributions and the HSAs, the Roth distribution does the same thing in terms of tax-free, but you don't have the availability of cash at any point in your life until you've passed the age of 59 and a half. That's huge. Then the HSA, only for medical expenses, except when you get in retirement, then you can take distributions for income, but then it's taxed as ordinary income. So it's a major, and again, the reverse mortgage, there's no taxation, but you're taking equity from the property when it goes to sell. And you can sell it prior to you passing, or your heirs can sell it when you pass to get whatever is necessary out that you haven't borrowed against. So again, you're not getting the full value out in that particular plan. You're just helping supplement income because you need the money. So again, when you rank these kind of things, this high cash value policies are the way to go when you want to keep money in motion and not let it just sit and accumulate and hope it achieves a dollar figure in the future.
Man, especially if you're a high net worth individual, if you're in a higher tax bracket and you wanted to take money out of one of these traditional plans, dude, you're going to be taxed 30, 40% on your income that you're drawing off of those plans. So the tax savings, to your point, is really beneficial. And it's the only vehicle that acts this way that you can actually utilize in this manner. And we've recently looked at different scenarios, where actually right now in the economy, we've got a lot of people taking money out of their 401k because inflation is going up. There's emergency medical expenses and emergency expenses that families need. I mean, things are rapidly getting more expensive every single day. And this is why we see the Fed has hiked interest rates super high to try to control inflation, which it hasn't controlled anything. People are still spending money. Credit card balances are higher than they've ever been. And more people need to know about these true tax-free vehicles, to Ron's point, that function like a bank, that you can go in and utilize your cash whenever you want, put it back. Let's talk to them about the real life scenario. I know you've got a couple clients. I've got clients, more than a couple, but you've got a client in particular who started one of these plans when they were a little bit younger. Just for the sake of the conversation, we're going to call him Billy. Billy started this plan when he was younger. Since then, and I'm probably talking more to your client, Billy, who owns the landscaping business, that started this plan when he was younger. Now he buys all of his vehicles. He buys all of his equipment. And I believe he has some real estate property. Give them like a real life example of somebody who's using these life insurance policies for the infinite banking concept, or to go over and have the ability to loan their own money without having to go to a bank, pay their self back. and inject some steroids into the plan? Give them that real life example.
Yeah, absolutely. I mean, and the big part of that is being able to leverage dollars and utilize those dollars for other asset opportunities. And this is kind of what we're talking about. It's that money in motion concept, meaning we want to keep money moving to force action in terms of gain, growth, additional asset plans, versus we're just going to contribute and hope that a dollar amount accumulates to this number that we hope is the desired number we need to retire. So in the example that you're describing with Billy, he was a younger gentleman, probably 29 years of age, somewhere in that neighborhood, when he first started participating in a whole life plan. Little hesitant, I will say. He didn't believe in the value of the plan based on things that we're describing here today, becoming your own banking system. One of those things where it's too good to be true kind of ideas. So he was still doing venture wise into a lot of different asset positions, but he had young family. He wanted to make sure they were protected. So he understood that aspect. So that's really why he got involved in doing this from the beginning. And basically was, hey, I'm going to learn as I go to see, is this really what you claim it states it's going to do? So fast forward a couple years, he decides to leave the position that he was doing on a full-time basis, and he was doing kind of landscaping through summer months and doing those kinds of things. And he decided to walk away from his position and go into the landscaping business for himself full-time. And by doing that, he needed capital. So capital for the business, employees, equipment, those types of things. So what he did is he called me up and he said, hey, do I really have cash in my policy that I can exercise? The answer was yes. And here's why. He was not only doing, and you can structure these plans any way you want. This is why it's important to make sure that we're having conversations with individuals to truly determine what are they trying to accomplish, not just short term, but long term, so we can devise a plan that really fits their formula. So what he wanted to do is he wanted in essence less death benefit, more cash going forward. So in structuring the plan in that fashion, he's paying a monthly premium, but you're able to actually exercise additional monies. This is the steroid that you were referring to, Will. He decided that he wanted the ability to add dollars to the plan in the future if he had the ability to do so from a financial perspective. So I built the plan in that fashion. He had a premium that he had to pay per month, but per year he had a maximum that he could add into the plan without having to go back further into underwriting. It was just the nature of what he could do. He started exercising that, and we call that a steroid, to your point, Will, where he's adding additional dollars above the premium because he has disposable income that he wanted to put in there that he knew was growing tax-free, and he wanted to build this system for himself to exercise. So sure enough, he walks away from his position. He's starting his landscaping business. He needs capital. He has the cash inside the plan because he was maximizing that opportunity over and above his premium that he was putting in that steroid of additional cash to accelerate cash availability in the future. So we fast forward, he decides he wants to do this. We take cash out of the policy. There's his capital to do what he needs in the short term to start his business with equipment and just a couple of employees to get things rolling the way he wanted it to go. Fast forward again, he pays himself back all of the money that he had taken out of the plan. He pays it all back to himself. He doesn't lose the earning power of that dollar while he was borrowing against it. He still continued to grow the cash inside the plan. He pays himself back through the business, which is also a potential tax deduction to the business because he has taken, in essence, a loan so you'd have to work with a CPA to make sure how that works. But he can then take, because if there's interest that's accruing, there's some possibilities for some tax deductions that I don't want to get too deep in that, but that's another segment that we can talk about. So he then pays himself back. Not more than a year later, he comes back and he's in a situation where he wants to expand his business even further. He has a building opportunity to purchase to help expand his business even further. He comes back. He needs the capital again. He now has more cash in the policy. He takes it out again, more this time, puts it in there, buys the building, helps purchase the building with the down payment through the cash of his policy, doesn't interrupt his cash flow whatsoever. Again, puts himself on a system to pay himself back. He pays himself back probably within about a 3-month period. He's done this 3 times, to my recollection, all for business purposes, to expand his business. Now he's in a situation where he has multiple vehicles that are out on the road, multiple crews that are doing their thing. He's generated more and more business, whether it's residential or commercial properties with the business that he's doing. He's expanded his business basically to the positive reality that he envisioned himself doing, but he did it through the policy of helping him with capital and not having to use the bank as much as we would normally have to do in circumstances of what I just described. He still had to use the bank maybe for an actual mortgage, but he utilized the cash position to offset down payments and not interrupt cash flow that was happening within his business at all. And all along, he's continued to increase cash position inside that plan. All the money is paid back. He made money in his policy at the same time he was making profit in his business. He made $1 become $2. And those $2 are all growing at different rates because of how much is he profit-wise is he trying to keep within his business versus this is a traditional business owner versus trying to expand his business. How much money do I pour back into my business from my profits to maintain what I'm doing or expand what I'm doing? He's done this in such an intelligent way. We've helped guide him through this, and this is what we talk about. This is not the only position, only plan you want to have in place, but this is an unbelievable springboard and an unbelievable safety net to have it just like a home. You have to have a foundation to build that house that's going to collapse. This is kind of the same premise. We want to have a plan like this in place to keep the foundation of our finances in place to where they don't crumble down if something negative happens. He has something like this in place. It's not the only thing he's doing, but man, is this a fantastic vehicle to do what he's doing and still be able to do things for his family if necessary, for education for his kids in the future. He's using it for business purposes now. He can buy vehicles through this for not only his business, for his personal life. And you utilize your banking system and you pay yourself back instead of paying someone else. Quit losing the opportunity. That's the lost opportunity cost on that money well into the future that you cannot possibly imagine how much money you're losing. This is a fantastic plan as a foundation to do so many different things in your life.
Man, let's talk about that, because while you're telling us about Billy, what I'm hearing is the average entrepreneur out there. You've worked with business owners for years. I've been a business owner for years. And what Billy was able to do is to start a real business immediately because he had that money within his policy. He didn't have to, build out a business plan, take that business plan to a banker and beg them to give him capital to start his business properly. Or he didn't have to go through that sole proprietor stage where he was able to go out, hire employees immediately and start a real business versus creating a high-paying job for himself and working it into a business. I mean, I've done that several times. And what he's capable of doing with the cash value within his policy is time and time again, bypass the bank, bypass the credit system, bypass timing, right? Having to wait on a loan, having to wait to get pre-qualified for a loan, having to wait on the funds to be released, and all these different, minute pieces of operating and owning a business that the average person doesn't think of. But I wonder how many of you are out in corporate America right now and you guys have the same dream that Billy did, where he wants to capitalize, where you want to capitalize on being an entrepreneur, creating your own wealth. And you're sitting in a position now where you don't know where you're going to get the money from. the way that Billy utilized this life insurance policy, from working full time, starting a part-time business on the side, putting money back into the life insurance, not even knowing that later on he was going to take that money out to start his business and change his family's life forever. Man, it's a powerful story.
Yeah, basically, I mean, if you want to really make this simplistic, what he did by delaying his start of his business full-time versus just part-time as a side hustle, because that's what it was a side hustle basically. By doing this and then flipping the switch to making the decision, hey, I'm walking away from my full-time gig and I'm making the side hustle my full-time gig. And what he did in that interim between that decision and the time he got the policy, he in essence set up his own business line of credit. So think about when a business owner is doing that, they most of these individuals, depending on the business that they're in, but they typically have lines of credit to utilize as fail safes to keep the operations going, the flow of money. If there's, think about receivables, account receivables, depending on what the industry is, it might take you a while to collect your money from your clients that you've done services or business for. Well, you need money to make sure that the business continue to flow. Well, if you don't have all your receivables in, these business owners depend on a line of credit to make sure that they don't go underwater and business maintains. Well, think about that. If you have a traditional line of credit, they're borrowing against that. They have to pay that back to the bank plus interest, whatever that interest rate's attached to that loan, and they never get access to that money ever again in terms of the payments that they're making back to that line of credit. It's gone. It's going back into the line, but they don't know it's their money is being utilized in a different way because you're paying a different entity. He set up his own personal line of credit in theory. So now he's borrowing for himself, paying himself back and the interest. So if depending on how it is accruing, when I've talked about this with you before, Will, when you go to a bank and people are so fixated on interest rates and payments back, how much interest am I really paying? When you get involved in something like this, you start to ignore. That sounds ridiculous. You start to ignore the interest that you're paying because you're paying yourself. You're not paying someone else. So it changes the whole philosophy and mindset of how you view money. Because now everything is yours. You're utilizing your own personal system to make everything work. And you can get to a point where there's cash in that policy that you do not need the bank in any shape or form, period. Because as you build up and more cash is there, that line of credit keeps getting bigger and bigger and bigger and bigger. You didn't go get a $100,000 line of credit through the bank. Now you have a $500,000 line of credit because you've continued to make the growth keeps happening and there's just more availability to you. The sky's the limit. You talked about annual income limits when it came to the Roth IRA. You know, it's also contribution limits to a Roth IRA. There's contribution limits to IRAs. There's contribution limits to 401ks, 403bs. These all have limitations. And I don't want to make it sound like there are zero limitations in cash value policies, because there are. We have to stay below what's called a modified endowment limit to make sure we don't have taxable events occur. But those limits are severely greater than anything you can possibly do in these other plans. High income earners, like you're saying, but just middle America that we talk to more than we do high end, like you're referencing a few minutes ago, Will. Middle America needs a way to funnel money that we don't have to pay taxes. We have to avoid taxation as much as possible. So when we talk about this, business owners are huge for this. We need to generate for individuals more passive income, meaning that you're just collecting money off something else that's working on your behalf. Real estate, as an example, that's passive income. You're making money off something else because of where their income is, the profit is coming from in rents and those types of things. You're getting paid because you own the building, you own the property. That becomes a tax write-off as well because there's deductions that happen. There's so many things that are available for people because you have a plan like this that gives you freedoms that you typically don't have otherwise. Now, those that are wealthy have a lot more freedoms because they just have more cash flow. But the average person is trying to find a way to get ahead and stay there, not get ahead, fall back, try to get ahead and fall back again, because their plans are on this roller coaster. It's up one day, down the next, up 1 month, down the next. We have to stop that process from happening. And that's all that's happening. I'm not saying you don't participate in those things, but man, your eggs cannot solely be in that type of a basket.
No, especially when we're talking, to your point, in the example of Billy, most businesses go out of business in the first 3 years. Then you've got a high percentage that go out in 5 years. You've got a higher percentage that don't last 10 years. And the number one reason these businesses go out of business is because of cash flow. That's the number one thing that knocks them out. And behind that, the fear of starting and operating a business, like Billy did, the fear is, what if it doesn't work? Well, if it doesn't work, you just owe you the money back. It doesn't totally just destroy your credit, destroy your lending opportunities, and just run you through the ground. Because with banks, everything is attached to your personal credit. So I've been there, done that. And if I would have known that these plans existed, I would have been in a way better position with cash flow when I had my other businesses and operated them. So just to rehash, and Ron, we could talk about this all day, dude. I mean, me and you could literally go in probably 12 hours today just talking about the tax-free benefits of life insurance. But 4 types of income not taxed in retirement. Rolling back, the bottom tier, the 4th type we covered was the HSA. Number 3 was the reverse mortgage. Number 2 was the qualified Roth plans, whether it's a Roth IRA or a Roth 401k. And the number 1 best vehicle, not taxed income for retirement, the IUL whole life insurance, tax-free retirement strategy that we've gone into depth on.